Alright, stop scrolling for a second because something big just happened, and it's still unfolding as you're watching this. Silver opened the week down more than 30% from last week's $121.64 peak, printing around $81 to $82 an ounce, after briefly flushing near $71 overnight. That's not a typo. Tens of billions in notional value vanished in a matter of days. And here's the real thesis you need to hear right now. This wasn't just fear or a bad headline. The real trigger was mechanical. A roughly 36% margin hike from CME Group just collided with a leveraged market as global trading desks reopened. Stay with me, because if you understand this pattern now, you'll recognize it the next time it shows up, before the crowd does. Before I explain what caused this move, let me teach you something most people never really internalize about markets. Prices don't just move because opinions change, they move because positioning breaks. And I want you to really understand that difference because it's the foundation for everything we're going to talk about today. Think of leverage like a bridge carrying too much weight. It looks fine. Everything seems normal. Traffic's flowing. Until one extra truck rolls on. Then suddenly the structure can't handle it anymore. Margin requirements are the toll booth on that bridge. When the toll suddenly jumps, some vehicles don't get to pass anymore. They're forced to turn around. And when enough of them turn around at once, price doesn't gently drift lower. It gaps. It slides. It cascades. That's why you can have a market where the long-term story hasn't changed at all, but the short-term price action looks absolutely violent. The fundamentals can be identical. The same supply constraints, the same demand drivers, the same macro backdrop. But price is collapsing anyway. Why? Because someone who was long with leverage yesterday literally cannot afford to stay long today. Their broker won't let them. The clearinghouse won't let them. The math won't let them. So when you're watching a crash like this, the first question you should ask isn't what do people feel? It's who's being forced to act, who doesn't have a choice anymore. Because voluntary selling and forced selling create completely different price dynamics. Voluntary selling happens when someone changes their mind. They reassess the story. They lose confidence. They decide to take profits or cut losses on their own terms. That kind of selling tends to be gradual. It tends to show up as distribution over time. But forced selling is different. Forced selling happens when the market makes you exit, when you run out of collateral, when margin clerks start calling, when your risk limits get breached. That's not a decision. That's survival. And survival selling doesn't care about fair value or long-term prospects. It only cares about meeting the immediate demand for cash or collateral right now. So what does that tell us? It tells us that if you want to understand why markets crash, you've got to understand the plumbing, the mechanics, the leverage, the margining systems. Because sometimes the most violent moves have nothing to do with the story changing and everything to do with the structure breaking. And if this is making sense, drop a comment below because I want to know if you've seen this pattern play out in other markets before. Now here's what's actually happening under the hood. Let me break down the sequence because this part matters. Silver had been trading hot, crowded, and heavily leveraged into that $120 area. Momentum had been strong. Retail was piling in. Social media was buzzing. Everyone felt like they were early to something big. And maybe they were early to the story. But they weren't early to the positioning, because by the time silver hit those highs, the futures market was absolutely loaded. Speculative longs were at multi-year highs. Open interest was elevated, and a lot of that exposure was held on margin, which means traders were borrowing capacity to hold larger positions than their cash would normally allow. Then margin requirements get raised by about 36%. That means anyone holding futures suddenly needs a lot more cash immediately just to keep the same position, not to add to it, not to double down, just to maintain what they already own. So when Asia opens, then Europe, then futures liquidity starts to rebuild after the weekend. Traders who can't post that cash don't have a choice. They sell. And remember, this isn't a gentle rebalancing. This is urgent. This is the clearinghouse saying you have hours, sometimes minutes, to meet your margin call, or we're liquidating your position for you. That selling pushes price down, and when price drops, it triggers more margin stress for other participants, which forces more selling. That's the cascade. It's a feedback loop. Lower prices create more margin pressure, which creates more forced selling, which pushes prices even lower, and what validates it is the timing. This all hits right as global markets reopen, when liquidity is thinner than usual and stop levels are obvious to everyone watching. The algos know where the stops are. The market makers know where the stops are, and once those stops start getting hit, it becomes a race to the exits. Now add in the chatter. You've probably seen the headlines. Positioning questions at JP Chase. Temporary disruptions around the London Metal Exchange, clearing noise involving HSBC. I'm not here to confirm or deny the details of those reports because honestly, half of what circulates during a crash is speculation anyway. But here's what matters. When you combine forced liquidation with narrative uncertainty about major institutions, You get a situation that feels explosive. You get fear amplifying mechanical pressure. And that's when things can really get out of hand. But here's the part that should make you nervous. Once forced liquidation starts, it doesn't care about fair value. It doesn't matter if silver is fundamentally worth $80 or $120 or $50. The selling isn't based on a forecast. It's based on a margin call. And that means price can overshoot to the downside just as violently as it overshot to the upside on the way up. You get dislocations. You get price discovery that doesn't make sense if you're only thinking about supply and demand fundamentals. Because in that moment, the biggest supply of silver isn't coming from mines or recycling. It's coming from leveraged traders who are being liquidated. Now let me show you what very few people are talking about. The convergence. Because it wasn't just the margin hike in isolation. It was the margin hike happening at a specific moment in the market structure. Think about it. Silver had rallied hard. That means a lot of people bought high. They bought at 110, 115, 120. Their cost basis is elevated. Their pain threshold is lower. And many of them used leverage to participate because that's what you do when you think something's going parabolic. You maximize your exposure. So when the margin requirement jumps, you've got this combination. High cost basis, high leverage, and suddenly higher capital requirements. That's three sources of pressure hitting the same group of market participants at the same time. And if that group is large enough, which it clearly was based on the open interest data, then the unwinding isn't optional, it's mechanical, it's structural. You're not asking people to change their mind about silver. You're forcing them to liquidate because the math doesn't work anymore. And then there's the liquidity component. Margin hikes don't happen in a vacuum. They usually happen after a big move, which is exactly when positioning is most extended. So you've got maximum exposure meeting maximum stress at a moment when market depth might actually be shallower than normal because everyone who wanted to be long already is long. There's no fresh capital waiting on the sidelines to absorb the selling. The buyers are exhausted. The momentum chasers are fully invested. And now the sellers are forced, not voluntary. That's the convergence. Elevated positioning, higher margin requirements, and depleted liquidity all happening together. And when those three things align, you don't get a pullback. You get a flush. You get the kind of move we just saw where 30 to 40% of value disappears in days. Now, this is also where people get tripped up because they assume the first bounce means the worst is over. I need you to zoom out for a second because we've seen this movie before. And every time it plays, people make the same mistakes at the same points in the cycle. Let me walk you through the pattern. In 2011, silver had one of its most famous crashes. It ran from around $30 to nearly $50 in a matter of weeks. Pure mania. Then it crashed. Margin requirements got hiked, leveraged positions got liquidated, and silver dropped back into the 30s within days. Sound familiar? Here's what most people forget. That initial crash low didn't hold. The following Monday didn't mark a clean bottom. It marked a volatility reset with multiple retests. Silver chopped around for weeks. It bounced. It broke down again. It retested lower levels. Why? Because the forced selling created such a disruption in positioning that it took time for the market to find equilibrium again. Real buyers needed to see stability before stepping in, and stability doesn't show up overnight after a liquidation event. Fast forward to March 2020. Different asset class, but same mechanics. When COVID hit and markets seized up, you saw forced liquidation everywhere. Margin calls, redemptions, funds having to sell what they could, not what they wanted to. Gold, which you'd think would be a safe haven, actually sold off hard in the initial panic. Why? Because funds needed to raise cash, and gold was liquid. They weren't selling because they thought gold was a bad investment. They were selling because they had to meet margin calls in other positions. And guess what happened after that initial flush? The market chopped. It retested. It took days, even weeks in some cases, before you got a sustained move higher. The early bounce sucked people in emotionally, but the real bottom came later when the forced selling actually exhausted itself. Same thing in the oil market during the negative price event in April 2020. Futures contracts went negative, literally below zero. Was that because oil suddenly had no value? No. It was because traders holding contracts that were about to expire had no physical storage available and were forced to pay someone to take the contracts off their hands. Pure mechanical pressure. And after that initial flush, what happened? Volatility, retests, instability. Because forced liquidation creates a void that takes time to fill. Every time this setup appears, the pattern is the same. The early bounce looks encouraging. Buyers step in thinking they're getting a bargain. Price rallies 10, 15, 20% off the lows, and everyone breathes a sigh of relief. But then the second wave hits. More forced selling trickles in. More margin calls get processed. More weak hands shake out. And the market retests those lows, or even makes new ones before finally stabilizing. The larger story here is that post-crash Mondays are usually about discovery, not resolution. The market is trying to figure out where the real buyers are, where the forced selling ends, where natural support exists without the leverage that caused the crash in the first place. So when you look at silver right now, bouncing off that $70 to $80 zone, you've got to ask yourself, is this the bottom, or is this just the first bounce in a larger process? History says, be patient. History says, wait for the volatility to compress. Wait for the selling pressure to actually fade, not just for price to snap higher on a short squeeze or a technical bounce. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be some grand, coordinated manipulation? Let me be honest with you. Claims about engineered crashes sound compelling, especially when big institutions are involved. And yes, margin changes always favor strong balance sheets over weak ones. That's just reality. The players with deep pockets can ride out the volatility. The players on margin get washed out. So in that sense, there's always an asymmetry. The system is designed to protect the clearinghouses and the well-capitalized participants, not the speculative trader using maximum leverage. Could there have been someone on the other side of this trade who benefited from the crash? Yeah, probably. There usually is. Short sellers who timed it right, market makers who were delta neutral and profited from the volatility, institutions who exited earlier and are now buying back cheaper. That's how markets work. Every seller has a buyer. Every forced liquidation creates an opportunity for someone else. But here's the thing. It doesn't actually matter whether there was some master plan or whether this was just the natural consequence of leverage and margin mechanics. Because either way, your job as a trader or an investor is the same. Understand the structure. Manage your risk. Don't use so much leverage that a margin hike can wipe you out. Focus on what you can control, not on conspiracy theories that may or may not be true and definitely can't be proven. You don't need a villain to explain this move. You need math, leverage, and timing. Margin requirements rose. That's a fact. Leverage was high. That's a fact. And liquidation followed. That's a fact. That framework will serve you better than chasing some shadowy narrative on social media about who's pulling the strings, because even if someone is pulling the strings, what are you going to do about it? You can't control that. What you can control is your position size, your risk management, and your understanding of how these mechanical forces work. So yeah, be skeptical of the official narratives. Be skeptical of the conspiracy theories too, and focus on the mechanics, because those are what you can verify and learn from. There are probably 3 types of people watching this right now, and I want to speak to each of you directly because your situation is different, and the advice that's right for you isn't necessarily right for someone else. Maybe you're long silver and you're staring at your screen wondering if you just lived through the top. If that's you, breathe. I know it feels bad. I know seeing your position down 30, 40, maybe 50% in a matter of days is brutal. But your job right now isn't to predict whether silver bounces tomorrow or crashes further next week. Your job is to manage risk and decide what level actually invalidates your thesis. Ask yourself, why did you get long in the first place? Was it because you believed in a long-term monetary story? Was it because you thought industrial demand would drive prices higher? Was it because you were playing momentum? Whatever the reason, has that reason fundamentally changed? If the answer is no, if the thesis is still intact, then this might just be a shakeout. But if the answer is yes, if something broke in your original analysis, then respect that and adjust your position. Don't hold on out of stubbornness or hope. Hold on because you still believe in the trade with proper risk management. Maybe you're flat and feeling like you missed something huge. Maybe you were watching silver run and you didn't pull the trigger. And now you're seeing it crash and you're thinking, should I buy the dip? That's normal. Missing a move is painful. FOMO is real. But let me tell you something. Chasing forced selling is worse than missing the initial move. Because when you buy into a liquidation event without waiting for confirmation that the selling is done, you're essentially trying to catch a falling knife. You might get lucky. You might nail the exact bottom, but more likely you're going to get chopped up as the market retests and continues to shake out weak hands. So if you're flat, stay patient. Let the dust settle. Wait for signs that the forced selling is exhausted. Wait for volatility to compress. Wait for a base to form. The opportunity will still be there if the longer-term thesis is correct. You don't have to buy the exact bottom to make money. You just have to buy when the risk-reward is actually in your favor. Or maybe you're experienced and already thinking in terms of volatility and structure. Maybe you've seen crashes before. You've traded through them. You know how this works. For you, this is about patience and confirmation, not bravado. You're not trying to be a hero. You're not trying to impress anyone with how you bought the exact low. You're waiting for the market to show you that it's ready to stabilize. You're watching the order flow. You're watching whether the bounces hold or fail. You're watching whether volatility starts to decline or continues to spike. You know that in these situations, the traders who survive aren't the ones who guess right. They're the ones who wait for the market to tell them when the risk has actually shifted. No matter which camp you're in, the universal principle is the same. Wait for pressure to ease before trusting price. Wait for the forced selling to exhaust itself. Wait for the market to prove that it can hold a level, not just bounce off it. Because bounces are easy. Holding support is hard. And the difference between the two is everything. So here's what I want you to answer in the comments. Where are you right now? Are you long and holding? Are you flat and watching? Are you trying to figure out if this is the opportunity you've been waiting for? Let me know, because I read every comment and I want to understand where this community is positioned mentally. Now let me tell you where I stand. I'm not bullish or bearish emotionally. I'm conditional. And I think that's the only intellectually honest way to approach a market like this. First, I'm watching that $80 to $82 zone because that's immediate support, and that's where we're sitting right now as I'm recording this. If silver can hold above 80 and start to build some consolidation there, that would suggest the initial forced selling has run its course. It wouldn't mean we're going straight back to 120, but it would mean the downside pressure is easing. Second, I'm watching the $70 to $75 area as a potential deeper washout if forced selling isn't done. If we break 80 and start trending toward that lower range, that tells me there's still more liquidation working through the system. And in that case, I'd be patient. I'd wait for a test of that zone and then watch how the market responds. Does it bounce hard? Does it chop? Does it break through? The reaction will tell us a lot about where the real support is. Third, I'm watching the tape itself. Does volatility compress into the US close, or does selling stay aggressive? Do we see follow-through selling in Asia tonight, or does the market start to stabilize? Because if this move was purely mechanical, if it was driven by margin calls and forced liquidation, then once that pressure exhausts itself, you should see volatility start to decline. The intraday ranges should get smaller. The bounces should start to hold. That would be the first sign that we're transitioning from forced selling to normal price discovery. Fourth, I'm monitoring any additional news or developments around margin requirements, clearing issues, or institutional positioning. If CME hikes margins again, that's more pressure. If there's clarity around some of the institutional chatter, that could either calm things down or make them worse, depending on what actually happened. Information matters in situations like this. And fifth, I'm keeping an eye on the dollar, on rates, on the broader macro picture, because silver doesn't trade in a vacuum. If the dollar strengthens significantly, that's going to be a headwind for silver regardless of the forced selling dynamics. If rates spike, same thing. So the fundamental backdrop still matters, even if this particular move was mechanical. Based on my analysis, this event was structural and technical, not fundamental. The margin hike triggered forced liquidation in a leveraged market at a time when positioning was extended and liquidity was thin. That's the core mechanism. The fundamental picture for silver, the longer-term story about monetary debasement, industrial demand, supply constraints, that hasn't changed overnight. Central banks are still running deficits. Governments are still printing money. Industrial applications for silver in solar panels, in electronics, in batteries, those demand drivers are still intact. But here's what did change. The market structure broke. Leverage got washed out. Weak hands got shaken out, and now we're in a reset phase where the market has to find a new equilibrium without all that speculative froth. And if history rhymes, if silver can stabilize and start to rebuild a base here, the move that follows could be significant. Not because of the crash, but because the crash cleared out the excess leverage that was probably going to cap the upside anyway. Let me be clear, I'm not a financial advisor. This is not financial advice. Everything I've shared here is my analysis, my perspective, my interpretation of the data. You need to do your own research. You need to make your own decisions based on your own risk tolerance and your own financial situation. Don't trade based on what some voice on the internet tells you, even if that voice is mine. But if you made it this far, you're thinking critically. You're not just reacting emotionally to price action. You're trying to understand the structure, the mechanics, the why behind the move, and that mentality will serve you well, regardless of what happens next in silver. Because the next time you see a margin hike, the next time you see forced liquidation, the next time you see a market crash that doesn't seem to match the fundamental story, you'll recognize the pattern. You'll know what to look for. You'll know to ask who's being forced to act instead of just assuming people change their minds. If you found this valuable, share it with someone who needs to see it. Hit that subscribe button if you want more breakdowns like this. And stay ahead of the noise by thinking for yourself, verifying what you hear, and always managing your risk. Think critically. Stay sharp out there.